Welcome back to the Deep Dive. Today we're going to focus on just one company, Dole Eek.
Ticker DOLE.
Right, ticker DOLE. And the story here is, it's really shifted in this latest Q3 earnings call. For the last year, it's been all about fixing the balance sheet.
A real grind. Just repair.
Exactly. But this quarter signals a really clear change. The narrative is moving on from that cleanup phase and into, shareholder returns and actual growth. We're here to unpack how they pulled off a huge sale, announced a buyback, and navigated some pretty serious headwinds all at once.
It was a very busy quarter for them.
So let's start with the top line numbers, because I think they set the stage for everything else. It was a quarter defined by a big revenue beat that kind of papered over some of the other weaknesses.
It really did. That's the core of it for you as an investor. Total revenue was $2.279 billion.
And the consensus was what, closer to $2.19 billion?
Yeah, so they beat by almost $90 million. That's a huge surprise in this sector. It works out to about 10.5% reported growth year over year, or 8.2% on a like-for-like basis.
So real underlying demand. But when you move down to profitability, that's where the first sort of complication comes in, right?
Yeah.
Adjusted EBITDA was actually down a little.
Just a little bit. It came in at $80.8 million, which is down 1.6% from last year. And you're right to ask, how can revenue be up so much and EBITDA be down?
Yeah, what's the story there?
It's purely about the mix of what they sold. The parts of the business that grew the fastest, their diversified fresh produce segments, they just run at slightly lower margins than the fresh fruit segment, so more volume, but from slightly less profitable sales.
Okay, that makes sense. And that complexity, I guess, shows up even more in the earnings per share.
It really does. Their adjusted diluted EPS, the number the street looks at, was 16 cents, which sounds fine.
But the GAAP number, the official accounting number, was way lower.
Way lower. Only 5 cents. And that gap, that 11-cent difference, that's where you find the big strategic action of the quarter.
So what drove that massive divergence?
It's almost entirely from one thing, a $10.2 million loss that's tied to what they call discontinued operations.
Which is just accounting speak for the sale of the fresh vegetables division.
Exactly. When you sell a business, you have to account for all the closing costs and write-downs, and that hits your GAAP number right away, even if it's a good long-term move.
And the market completely understood that. It just looked right past it.
Yeah.
The stock closed up 5% on the news on huge volume.
Absolutely. The market's message was, we care more about the stronger company you're building for the future than some one-time accounting charge from the past.
So let's talk about that future structure, because that's really the headline here.
Yeah.
It all started with completing that fresh vegetable sale.
It did. They finally got it done in early August. That brought in about $140 million in cash.
And what they did with that cash is the next key point for you, the listener. They didn't just let it sit in the bank.
No, they immediately used every dollar to pay down their revolver borrowings. Their net debt, which was creeping up toward $800 million before, is now down to $664.5 million.
That's not just a number, that's a real milestone. It signals they're getting their leverage under control, which is what gave them the green light to finally pivot to shareholder returns.
And they did it immediately.
Yeah, that's what was so strong. They translated that balance sheet confidence directly into a new $100 million share buyback authorization.
Which is a huge signal.
Yeah.
And they were careful to position it as an opportunistic tool. That's an important distinction for you to understand.
So what does that mean, opportunistic? It's not just a promise to buy shares no matter what.
Right. It means they've likely set up something called a 10b5-1 plan. It's basically an automated trading plan. They're telling the market, we think our stock is worth more than the current price, and if it dips to a level we find attractive, this plan will automatically kick in and start buying shares.
So it puts a sort of psychological floor under the stock price.
Exactly. It's a huge vote of confidence from management in their own valuation. And you pair that with the steady dividend, which they declared again at 8.5 cents per share.
And you really see that transition from a company that was just trying to survive to one that's now focused on distributing capital back to its owners.
And you see that confidence again in their updated guidance. They tightened their full-year adjusted EBITDA forecast to the upper end of the $380 to $390 million range. That's high conviction.
They also held their interest expense forecast steady at around $67 million, which shows the debt reduction is working.
Yep. Now, one small thing people might misinterpret is the change to CapEx. They did tighten the capital expenditure forecast down to about $85 million for the year.
Which could look like you're cutting back on investment.
It could, but management was really clean on this. It's not a structural cut. It was purely about the timing of a few projects that just got delayed and won't be finished by year end. They said their long-term target is still closer to $100 million, which lines up with their depreciation. So no pullback on investment.
Okay, so let's get into the operations, because this is where the diversification strategy really proved its worth this quarter.
It's the whole story. The diversified fresh produce segments, so Europe, the Americas, and the rest of the world, they did all the heavy lifting.
The momentum there was incredible, especially in EMEA.
The growth was just staggering. Adjusted EBITDA in EMEA was up 34% as reported, and 24% on a like-for-like basis.
24% growth in a mature market like European produce is just massive. What was driving that?
It comes down to investments they've been making in their own distribution and logistics. Better cold storage, faster hubs, especially in places like Spain, the Netherlands, and the Nordics. It just means a fresher product gets to the supermarket shelf faster.
So they get better pricing, and it's more efficient. It's not just selling more, it's selling better.
Exactly. And you saw the same thing in the Americas, even though Q3 is usually their quietest quarter.
Yeah, I saw that. Adjusted EBITDA up 46% year over year.
It was driven by really high-value stuff, specifically kiwis and berries in the North American market. These are premium products with great margins. They might not be huge volume drivers like bananas, but they punch way above their weight on profitability.
And they're still streamlining things there too, right?
They are. They're integrating their North America business into Oppie, their biggest distribution platform. It's all about cutting out redundancies and making the whole system more efficient. It suggests this strong performance isn't just a fluke.
Okay, so now we have to talk about the flip side of the coin, the headwind. The fresh fruit segment.
Right. And this is where that slight dip in overall profitability came from. The results in fresh fruit, which is mostly bananas, were down and everyone expected it. The segment is just getting hammered by higher sourcing costs.
And it's not just one thing. It's like a perfect storm of issues.
It really is. First, you have their own farms in Honduras still recovering from tropical storm, Sarah. Now, insurance is covering the $25 million cost, which is great, but the disruption means they have less of their own low-cost fruit.
So they have to buy it from somewhere else.
Right. And that's problem number 2 and 3. The entire industry is seeing major supply issues out of Panama and Costa Rica. So with 2 other big suppliers having problems.
The price on the open market for whatever's left just skyrockets.
Precisely. So they were forced to go to the spot market, mostly in Ecuador, and pay much higher prices just to fill their contracts. So it's a major but temporary cost pressure.
The key word there is temporary. And on the demand side, things are still good.
Very good. Management was clear that demand for bananas is still robust in both North America and Europe. So this isn't a consumer problem, it's a supply chain problem.
We should also touch on the innovation side here, because they launched the new Dole Colada Royale pineapple.
Yeah, and this is not just some marketing gimmick. This was a 15-year R&D project. It's the first new pineapple variety they've launched in ages, all developed through non-GMO breeding.
It's already selling at a premium.
A material premium. It shows that even while they're fighting these short-term fires, the long-term innovation engine is still running.
Okay, so let's shift back to the near term. Analysts on the call really pressed them on the implied Q4 slowdown.
They did, because if you do the math to hit that upper end of the guidance for the full year, it implies about a 10% decline in adjusted EBITDA in the fourth quarter compared to last year.
Which is a tough number to see.
It is, but they laid it out. It's 2 things. First, it's that cost versus price problem in bananas that we just talked about. And second, Q4 of 2024 was just a spectacularly good quarter, an incredibly high benchmark. So the comparison is just really tough.
So looking ahead to 2026, the contract negotiation season is starting. They need to pass these higher costs on to retailers. How are they feeling about that?
It sounded, cautiously optimistic. And the reason is this isn't just a Dole problem.
It's an industry-wide problem.
Exactly. The retailers know that everyone is facing supply issues from Honduras, Panama, Costa Rica. So the expectation is that the market will have to adjust, and they'll be able to get contracts signed for 2026 that reflect this new cost reality.
Let's do a quick macro check. Any update on tariffs?
Nothing specific. Management just repeated their argument that products that can't be grown in the U.S., like bananas and pineapples, shouldn't have tariffs. But they admitted the process is just painfully slow. The good news is no major tariff hit is baked into their current guidance.
And what about the health of the U.S. consumer? Any worries about government shutdowns or S&P benefits?
They saw some anecdotal softness in areas with a lot of government workers, maybe some shifting to discount stores, but they emphasized that their most affordable products, especially bananas, do well in every retail channel, so they feel pretty well positioned.
Overall, consumer demand is healthy, and the focus on affordability and health is, right in their wheelhouse.
It really is.
Okay, let's pivot to our final segment, the one we call This is Not Financial Advice. This is where we take all this data and pitch an outrageous but plausible trade idea to the committee.
And this quarter, with this huge conflict between short-term pain and long-term gain, it sets up a perfect trade.
The company is fundamentally getting stronger, right? The asset sale is done, debt is down, there's a $100 billion buyback.
And the diversified parts of the business are on fire, but you have this temporary weather-related cost issue with bananas that's going to hit Q4 earnings.
So the thesis has to be about separating that long-term value from the short-term noise. What's the trade?
I'm calling it a buy the dip, short the headwind paired trade.
Ooh, okay. I like it. You're playing both sides.
You're playing the volatility. So leg one of the trade is aggressive. You short the stock heading into the year-end Q4 earnings release.
Why?
Because we know management has basically guided to a 10% EBITDA drop for the quarter. The market often overreacts to headline numbers like that, even when it knows the reason. So you capitalize on that potential overreaction.
And then the other side of the trade.
At the same time, you enter a long position. You could buy the stock or maybe some long-dated call options targeting the middle of 2026.
And the logic for that long bet is?
It's grounded in two things. First, that $100 million buyback acts as a pretty strong floor. It limits your downside risk. But second, and this is the crucial part, you're betting that by mid-2026, those new contracts will be in place, normalizing the margins in the fresh fruit business.
And once that happens?
Once that anchor is gone, the steady, powerful growth from the diversified segments, that 24% growth in Europe, that 46% in the Americas, that's what's going to drive the overall value of the company much, much higher. It's a bet on strategic stability winning out over temporary agricultural chaos.
So to wrap up this deep dive, Dole is executing its strategy. They've shed the assets they needed to, they've cut their debt, and they're rewarding shareholders with a big new buyback. The fresh fruit segment has some temporary problems, but the diversified business is more than strong enough to carry the load.
The company has really completed its transformation. It's a pure play, fresh produce and logistics company now. And that brings me to the provocative thought we want to leave you with.
Go for it.
Given the incredible success of that Colada Royale pineapple, which took 15 years of R&D, the question you should be mulling over is this. What's the next Colada Royale? What high-margin product, buried somewhere in those thriving diversified segments, is management quietly lining up for the next big, multi-year investment push? Because finding that is where the next decade of value is going to come from.
A great thought to end on. Thanks for joining us. And remember, everything we discussed today is a summary of corporate data and is not financial advice. Go forth and be well informed.